Good afternoon, everyone. In today's video, we'll do something very similar to yesterday's video, which is we'll go through all 9 futures markets and we'll go through step by step the same way we approach every single morning to try and identify where there were trade opportunities, where trades set up, and then what the result was. So in terms of actual volatility box trades, there was one that set up in the natural gas futures, and this did not work out. It was off of the doomsday aggressive models, and price just ended up going straight through our clouds in the subsequent hour, stopping us out of that trade. And so that was a loser of minus 180 bucks. Outside of this, when we go through all of the 9 futures markets, I'll also make it a point to touch on the squeeze signal trades that set up, both the winners and the losers. There were some nice winners, like one in the S&P, but also a pretty nasty loser in crude, right? So we'll talk about all of those. And out of all of these trades, so the volatility box plots the same regardless of time frame. There's zero room. There's zero room for subjectivity there, whether you're on a 1 minute chart, a 3 minute chart, a 5 minute chart. A breach is a breach. The only place where the subjectivity comes in is when you start to layer on our confidence signals, which for us is the edge signal indicator. And right now, with the volatility that's been going on, we've been talking about using the 1 minute time frame chart. So that's what we're going to use for the purposes of this activity. All right, so let's get started. We'll start with the S&P and just go straight down the line. So let's start with the chart of the S&P futures, and here we'll draw a line in that first full hour. We check to see if we breach either side's aggressive volatility box entry lines. We didn't, and that was your permission to continue to use your aggressive model. Now, if we had breached either side's lines, you could then switch to any one of our other 3 volatility models, and the way you can rank them is really the aggressive is the most aggressive, then the doomsday aggressive is the second most aggressive, then you have the conservative, which is now getting into more conservative territory, as well as the doomsday conservative, which is really ranked last. So using the aggressive volatility box here, we see that we did not breach either side's lines, and so that's your okay to continue to use those models. With the current volatility, we've talked about this in lots of videos, this in the trade plan as well, but with the most aggressive model, if we do breach our cyan line, we're then waiting for an edge signal confirmation and then an entry at the clouds instead of the cyan line, which then lets you cut your risk in half and let you use the cyan line as the actual target. And the reason for that is based off of the follow through that we're currently seeing, or the lack thereof, in the markets with the current volatility. So using that, in the case of the S&P, we did not have any breaches throughout the entire day in terms of either side's blue volatility box aggressive entry lines. Now, if we layer on our market pulse, what you should notice is we did have a couple squeeze signals. We had our first batch of squeeze signals plot right here towards that 7:30 a.m. Pacific hour. But the part that made this not so attractive was while it did meet the first and second condition of our trend trades, which is we want a bearish squeeze signal and we want the market pulse to also be agreeing bearishly, we were too close to a volatility box edge, right? In terms of risk to reward, this is our first target, the gray dash line. That would be your reward versus your risk, which was required on this trade, which was much greater for if you consider, say, the previous pivot point as being the bare minimum. And so that's where this trade doesn't really become all that attractive. It doesn't meet the third criteria in the sense of you're near a volatility box edge, so you're continuing to look. The next opportunity in the S&P came as you had another set of bullish squeeze signals, or at least just one, plot right here at the beginning of the 10 a.m. Pacific hour. So at this point, once again, let's go through the same checklist, which is we have a bullish squeeze signal, you have a bullish market pulse, and we're away from the volatility box target lines, right? This would be target 1, and that blue dashed line, if we squeeze this down a little bit, would be target 2. So that was your entry point. Now, to give you an idea of what that length is, that was right around 13 points, right? And so then comes the question of what becomes your stop. And we've talked about how using a different asset class outside of the main big futures contract for these sorts of trades is the smart way to go. The volatility box starts to give you information in terms of taking targets, and you can use even, say, something like the micros to cut their risk in half, or even options on SPY or the actual SPY ETF, whatever you prefer, but you need to give it enough room to where a 13-point sell-off, for example, doesn't necessarily cause emotions to take over, right? 13 points on the full-size contract over, say, a squeeze signals trade is about a $650 risk, which isn't one that I think we're willing to take. But then if you start to say that, hey, with micros, you could layer that in terms of 65 bucks, well, then that starts to become an interesting trade that you can also participate in, looking for a move in that same direction, using the same sort of system, which is you're going to get this thrust movement in one way. But you need to be prepared for trades that don't go your way as well, which we'll talk about in crude oil. Now the next squeeze signal that we had on the S&P was after that 1 o'clock bell, in which you had a bearish squeeze signal. Once again, if you were to just use that same sort of criteria, it's you had the squeeze signal, you had the bearish market pulse, you're away from the volatility box edge for that period if you were for some reason looking to trade that period, and you still haven't actually hit your target, but you would be looking for that with that 3 p.m. Pacific open. Now let's move on to the charts of the Nasdaq futures, and we'll repeat the same process. So if we start by drawing that first hour test, which is this yellow line, you should see that we don't breach either side's aggressive volatility box entry lines. And that's your permission to continue to use the aggressive models, right? And so now if we continue to just scroll down forward, we should notice is once again no breaches, but we did see another squeeze signal form right here towards the edge of an hour. So let's go through the checklist here one more time. So we see a bearish squeeze signal, so that's check number 1. We see we have a bearish market pulse for the most part, so that's check number 2. Now we have the third condition, which is, are we far enough from the volatility box line? Right, we've mentioned this. The first target is that gray dash line of that hour, and then the blue dash line is your second target, right? And so using that, if we pull out the trend line tool to measure, to give you an idea, using the close of the candle from the squeeze signal, that is around a 19.4 point risk, right? Or reward, opportunity reward that you're looking at. Now, if we reverse this in the opposite direction, which is 19.4, that takes you to inside of even the most recent pivot, which at that point is still fairly considered to be smothering the trade if you had put your stop right above here. And so that, from a risk to reward standpoint, does not make sense. This does not meet that third condition, and we continue to look for the next trade. So let's keep going forward. And if we move forward, what you should notice is no other trades in the Nasdaq for the rest of the day. Now let's come to the Dow. So we'll start to go through this a little bit quicker now that you should be getting the hang of it. But again, with the Dow and most of our markets today, we had the okay to use the aggressive volatility box outside of natural gas. We didn't breach either side's entry lines, and we're not looking for breaches. No breaches took place across the entire day, but we did have several squeeze signals, right? Our first squeeze signal was a bullish squeeze signal here, but our market pulse, if we zoom in, was red, letting you know that, hey, this is an opportunity that meets that second criteria. So we zoom back out. The next opportunity was a squeeze signal, which is a bearish squeeze signal. So you did have that first checkpoint. You had the market pulse agreeing with it, but you were at a volatility box edge at the close of the actual trigger candle. And so no trade there one more time since you were already at your target by the time you got your signal. So you continue looking for trades and no other trades in the Dow as well. Next up, we have the Russell. So the Russell also respected the aggressive volatility box, but didn't give us a breach. The only place we had any squeeze signals also set up was towards the final hour again of the market. So several reasons why that's not attractive. One is you're already towards the edge of an hour, but two, very similar to the Dow, by the time you got your signal, you were very close to that volatility box entry line, and so no real edge here, right? You may have had other opportunities to try and get into this trade closer towards the top, but the squeeze signals did not give you that opportunity. Now let's move on to a chart of gold. So let's come back to the beginning. And once again, we'll start by drawing that first hour test. In the case of gold, you did breach that volatility box entry line, but you also bounced from there. And so that was your okay to continue to use the aggressive models. You're now looking for a breach, and that first breach came right here. For those of you wondering why these aren't valid breaches, in real time, if you were looking at the market, our cyan line was plotted closer down to right here. As we continue to make a higher high, it's when the cyan line shifted up, giving you a more realistic place to go long, while the upper volatility box line stayed exactly where it was, right? Our short opportunity. So price hit the short trigger lines here. That was the only valid trade that took place, but this was towards the edge of an hour. So lower probabilities, but that does give us free information, right? You're able to evaluate whether the aggressive volatility box models are still respected. So at this point, you're checking to see whether or not you have a follow through of 6 points, which is what the cyan line minus the clouds is, right around 6 points, in the opposite direction if you were to continue to use the aggressive models. Now, gold does give you that follow through, which is then you're okay. Once again, it starts to add confidence that, hey, you can use the aggressive models because price action is giving us the follow through that we're expecting from these lines, even towards the edge of an hour, which is a lower probability trade as it is. Now you had the next trade set up in the subsequent hour in which you had price hit the volatility box lines once again towards the edge of an hour. You then had the edge arrow signals populate, and so this was then a valid trade. And if you did get an entry at the clouds before you had hit the follow through in the opposite direction, that could have still made for a fairly interesting trade, right? Which would have overlapped with the current hour's cyan line, and you would still be acting on what is considered to be a valid trade since it hadn't gone outside of the volatility box. Now that didn't happen, and instead gold did have the follow through right away, and so we're again on the lookout for the next batch of volatility signals, which did not take place in gold until we had squeeze signals towards the final close, which again the market pulse did not agree with. Right, we had bearish squeeze signals, but a bullish market pulse most recently. Now let's move on to a chart of natural gas, which did give us a trade, and it was a loser trade as it was. But the first hour test in natural gas is a little bit more interesting. So here we draw our beginning first hour test, and we're checking to see whether or not we breached either side's aggressive volatility box lines. You had here, right? And at this point, we're checking to see what happens. Do the buyers win from here? This is that first hour and start to move the natural gas market up higher, or do the sellers win and do we continue to see price action move down even outside of our volatility box clouds? And so in the case of natural gas, that was no questions asked. The sellers won that battle, right? And this is the point at which if you had the trading assistant clouds, it tells you to switch on over to a more conservative model. Now we talked about this earlier, but if you were to try and move on to the next conservative model, that then takes you to the doomsday agro models. So let's go ahead and load those in. So using the doomsday aggressive models, we can see that that does a much better job of accounting for that first hour volatility. Cool, so now we're continuing to look for trade opportunities the rest of the day. So as we move closer, we see we had a few different breaches. In the case of natural gas, both the short and the long entry set up real time. Here's some footage of the trade as it was setting up, in which you can see price hit our cyan line, but we didn't get the edge signal until price started to reverse away from the cyan line, and by the time we got the signal, we had already hit our actual first target. So that wasn't a valid trade, but we were on the lookout for that potential long on the opposite side. Now the short entry came and went just like that, right? The wick of this candle is what hit our cyan line, and price then continued to fall down lower. So if you're watching and observing the natural gas market, you were able to catch that, but if you're waiting for the edge signal like we were, you did not get a retest of that wick, which is where our cyan line was. So this was a missed trade opportunity in the sense of we saw it work out in front of us, but weren't really in it. At this point, the long is what's valid, and that's what we were able to catch. Price then hit our volatility box entry line. We had an edge signal right here, opportunity to enter at the cyan line or better, and at this point our target was at 1.625, stop is outside of the volatility box at 1.608, and we ended up falling just a little bit short of our target before ultimately reversing and getting stopped out. Now if we load in the market pulse, let's take a look at the squeeze signal that populated to see whether or not it was a valid trade. Do we have a bearish squeeze signal? Yes, so we had some reason to look at the charts. Now did we have the market pulse agreeing with that? No, right? Our most recent market pulse was green here. This wasn't a valid trade for us, even though it did give you a really nice flush down lower in natural gas. So that was a bit frustrating in the sense of our volatility box trade that we were able to catch after waiting for a confidence signal did not work out and fell just a few ticks short. And the trades that we missed because we were trying to be a little bit too cautious and layer on just one too many confirmation signals did end up working out. So that was a little frustrating in natural gas and sort of a good representation of a day like today in which we had minimal trade opportunities in markets that we like to trade. And in some of these other markets, we had trades that set up, but they just didn't work out. Now, if we move on to a chart of the 30-year bond, we'll go back to the aggressive volatility box. We'll start by looking at that same first hour, right? No breach of either side's aggressive volatility box lines. We're then continuing to wait to see any breaches throughout the rest of the day. Now, some of our more aggressive members have started to use the gray dash line, at least in this lower period of volatility. So if you are looking to participate in trades more often than not, then that's something you may be looking at because you can see the amount of times that we actually breach our gray dash line is a lot more than the actual blue cyan line. But if you're waiting for a true edge, then that ends up becoming the blue cyan line, which is what we're waiting for with our trade plan. But that's just another idea for those of you looking to be a bit more aggressive or at least start to scale in with micros, whatever you may be looking at, because there you're starting to see that you're getting breaches of the gray dash line along with the edge signal and prices to enter at that gray dash line or better, along with follow through in the opposite direction. But otherwise, no entries in the bonds, right? We're still waiting for the actual breaches. None of those happened along with any squeeze signals. Now moving to a chart of crude. Crude was a trade in which, using the aggressive volatility box, we respected the volatility box line, and then we had an opportunity to get short right here. So if I layer in the market pulse as well, and we go through that same checklist, so we had a bearish squeeze signal right here, you had a bearish market pulse, we even had an opportunity to enter at the market pulse line on a pullback, And at this point, the reward on the trade that we were looking for was right around 57 cents, which is where this gray dash line was. And then the second target was at the blue dash line, which is a stretch ways away, but that's the rules that our system and sort of these trades call for. But as a result, you should be using some other asset class instead of the full size futures to where you can give it that same bit of distance on the other side, which then allowed us to go above this previous pivot point. Now that fall through did not come, and in the case of the USO options, the put lost about 20% of its value in this upward movement. And if you were using, say, something like QM, then you were able to cut that $570 risk in half, which made your risk per contract $285. So you can scale in and out based off of whatever risk your account size is comfortable with. But whichever way you looked at it, this was a trade in which we had signals that were valid for us, and the trade just did not work in our favor. And finally, we'll conclude by taking a look at copper. So the unfortunate thing with copper is for any squeeze signals, we don't really have a good way to play them. There's no micro copper contract, there's no good liquid copper ETF, and the actual copper future, at least with say some of our squeeze signals right here, was too high of a risk, right? That was about 107 ticks in terms of the reward we were looking at, which also then equates to the risk that you'd be willing to give the trade, which did not work out. So in the case of copper, the only thing that was valid was the actual volatility box breaches. The aggressive volatility box was once again the one to use. We had no breaches of the cyan lines, but price once again continued to chop sideways inside of our edges, giving us no real edge. And for those of you wondering whether or not this is normal, this is in fact what we were more used to seeing before this volatility started, which is we hope that there are more days in which we don't see our edges being breached so that whenever the edges are breached, then we know that, hey, price is doing something that it typically doesn't do, and we do in fact see a reason to try and participate in that trade. All right, so hopefully that walkthrough of each of our 9 futures markets helped you. We went through both the volatility box fade trades in terms of breaches, and that was on the natural gas futures, along with squeeze signals in which we had some nice squeeze signals in the S&P, along with some not so nice signals and some losers rather in crude, along with some missed opportunities in natural gas. All right, I hope this walkthrough of all 9 futures markets helped. Good luck trading the rest of this week, and we'll see you in the next update.